All right, I found my board. Let's see if we can unlock your brain here with the case study on iRobot. iRobot's the name of the company, but you and I know it as Roomba. You know, Roomba is the product that we know so well, and there's a big deal going on. Amazon's been trying to buy this company for about a year, and let's walk through it. But first, let's rewind real fast just to give you a flavor of the people and where this company came from. It's a very interesting little story where they are on two paths, then they go on one path, then they focus. Let's dive in. Where it began with this guy. So in 1990, told you this goes back a ways, three guys from MIT's AI lab, artificial intelligence lab, get together. So AI's been around in certain circles for a long time. They designed robots for space, military, and defense, and were doing things like that. And three of them got together to build the company. And this guy, right over here, that I'm showing, there we go, right there. Colin Angle is the co-founder and the CEO, and he's the CEO to this day. And here's some of the cool robots they made. They made robots for a lot of uses, like industrial uses. Like if you've ever read about the Fukushima disaster that had on the nuclear power plant in Japan on the coast there, they actually built a robot that went in there in the radiation and was able to take measurements and do certain things that a human couldn't do because there was so much contamination and radiation. Sure, you could put a human in a contamination suit, but once they come out of there, the suit's contaminated, and it was just too much radiation there. But actually, it was an iRobot, industrial robot, that went in to perform some of it. So they were working with defense and a lot of interesting things. So that's where you may have heard about iRobot, because there's big stories written about this really cool industrial robot that was able to go in there to the Fukushima nuclear power disaster and get something done. So in other words, these are crazy smart guys that were making robots. Now, quick little history. 1998, you know, they got a DARPA contract. And by the way, that's a defense organization, does all kinds of very cool stuff. So now they're working on things called the PackBot, and then defense things. So I'm going to skip all that and go to 2002. They unveiled Roomba, and guess what? 1 million units were sold like in 2 years. So there's 1 million of these little robots running around sweeping people's floors, you know, putting small dogs out of work that would normally, you know, gobble up the potato chips. Now you had a little robot doing it. So 2005, they go public on NASDAQ because they're doing so well. You know, they were just cruising along since 1990. They weren't on the stock market. So 15 years after they were founded, they end up on the stock market, an IPO, under the ticker iRobot, iRobot. So here we go, iRobot, and they announced that they had acquired another manufacturer, the floor mopper Mint. So you could see they were very much into this. You know, 10 years after introducing the Roomba and it's doing well, they buy another floor cleaning robot. Very interesting. So you can tell they're very much into consumer. And not a surprise, 2016, they sell the military stuff. So the stuff that was making that custom robot that I mentioned that was useful at the Fukushima nuclear power plant disaster, all that, they sell all that stuff off the industrial side to Arlington Capital Partners so they could go focus on the consumer market. By the way, Arlington Capital Partners, that is a financial purchase. If it was bought by another company that made products, it would be a strategic purchase. So nonetheless, they divest through a financial acquisition to a financial buyer. So now they're focusing on it. So here's the products that were there from 2001 to 2010. And 2005 is when they went public. Very consumer-oriented. You recognize early Roombas. You recognize the shampoo machine and a few other things. Then here's the later generation Roombas. Roombas ultimately had an app so you could set the time that you wanted to go around, and they devised the thing where it would go back to its little home, plug itself into a charging station. Very cool. You see the whole evolution of it and other things, including the one that's a mop, because it sprays water out there or cleaning solution, and then it kind of sucks it up and everything. So it actually does a light mop on a kitchen floor or hardwood floor. Very interesting stuff. Nonetheless, these are the products, which brings us to now they've gone public. So after they go public, all those products, so 2005 they go public, Roomba's been out for 2 years, but you can see they never really got above 50 bucks. 50 bucks wouldn't happen until 2017. And so they were kind of floating between 35 and 50 bucks, and when they first went out, November 11, 2005, you can see there, $36.51. That was the IPO, and they never broke 50. Wait, what did I tell you about the defense stuff? They sold it in 2016. After they sold that stuff in 2016, 2017, oh, now they break free. Well, here's why they broke free. They broke free thanks to a thing called focus. They're focusing on the consumer market. They're focusing on one thing. The stock market can measure them. They can show profits and things, which they did, which we'll look at in a minute. But then you can see they go. And so they go up here, and then you can see a COVID pop, and then up in 2021, down in 22, down in 23, and they're right back where they started from, $36.78. Years ago, $36.51. So they're up 27 cents over all that time. So why is it that they started here and they ended up here, and yet Amazon wants to buy them? Well, let's take a look at what was going on. They did have some strong growth after divestiture of military, but they've slid back down to the price. Let's go see why. So I'm going to walk through this a little bit, and I'm going to go over this side and explain it. So right up here, we've got their revenue, $1.2 billion in 2019. You take away your cost of revenue, what it costs to build things. You have a gross profit of $543 million. You come down here, 45% gross margin means for every dollar you sell, you've got about 45 cents left. And at the bottom now, you've got $3.04 earnings per share and an EBITDA profit of $123 million. Well, that's pretty good. So let's go take a look. Remember that stock went jumping up in 2020? Well, it's because they went to $5.23. And take a look, from 1.2 to 1.4 and then to 1.5 in sales. However, you see some things happened here that their gross margin dropped way down from 47 cents on the dollar they would keep to 35 cents. And yet their operating expenses were kind of consistent, taking $181 million of operating income and turning it into $32 million. That's not good. Remember, it goes, and you saw the COVID drop, but then in 22, it drops again. Take a look at this. From 1.4 billion to 1.56 billion to 1.1 billion to the 12 months right now. So this is almost all of 23. TTM stands for trailing 12 months. They're only sitting there at $940 million, and the margin is way down. So they're working on losing $13.68 a share. When you put all this together, that's why, you know, as we go back one slide, that's why you go up there, because it looks like things are going really good, and then they go down, then you're up, and then all of a sudden you announce all of this and you end up here. Yeah, that's trouble. Well, why is Amazon looking to buy them? Well, number one, they have a lot of data. Number two, it's a robot product. So let's dive into why they bought them, because now we can see, wow, somebody's buying them? This looks like a company that's had its heyday and is now kind of sliding down. Well, in fact, they are. Why would Amazon want to buy? Let's turn the page, take a look. Amazon makes an offer in July of 22. So that was after that big year in 21. The stock was going up. Wow, look at that. You did so well. With all that revenue and the profit and earnings per share, Amazon offers $61 per share, $1.7 billion. It was a 25% premium over the $45 trading range. So Amazon is saying, we think you're undervalued in the market, and we're going to pay for that. We'll pay $61 a share, even though it's only trading at $45. Stock jumps up on that news, because now the stock theoretically is worth at least $61 if Amazon's going to pay that. So it jumps up on future value anticipation. Amazon said, hey, we're gonna have a bigger presence in these smart home things, and we're gonna put Alexa voice assistant in there. It says, you know, Alexa, tell Roomba to clean up the spilled potato chips. And Roomba comes out and does that. So you could see things, you know, going on like that. Alexa, tell Roomba to go home. And Roomba goes back and plugs itself in because there's people in the house and didn't want to trip over the robot, whatnot. So they want to put it together. And something else, there is Astro. Has anybody heard about Amazon Astro? Astro was a robot which had failed to resonate with consumers. So they're saying, hey, you guys have got a ton of data going back 10 years of making Roombas. You're doing a great job with them. Why don't we just buy you, put Alexa in it, and be it another Amazon product we're selling in addition to those home speakers and things like that? See where this is going? See where this is going? Amazon being clever. But in July of 23, what happens? iRobot gets $200 million in debt financing. Why? Well, we just saw they were starting to lose money. Revenue had gone down. Gross margin had gone down. EPS was suddenly on a trailing 12 basis this year, minus $13 per share. They needed capital to keep operating, and so they were a big company. They went out and got debt financing. This relates to the story on small business. Even on a lower scale, we can't go out and do that very easily unless you use a credit card, which is what small businesses are doing right now in Q4 of 2023 as we talk about this. Then Amazon says, all right, you guys are going out to get some debt, so we're going to drop the offer to 51 a share. Why do they do that? Well, if you're going to buy the company, but now there's $200 million in debt, you wouldn't pay 1.7 anymore. You'd pay 1.5 to account for the $2 billion you have to pay off to someone else. So price comes down because there's debt on the table. So Amazon's doing all this, and meanwhile, there were some regulatory concerns because Amazon is ginormous. So regulatory folks come out, because there's more than just Roomba making robots. So those companies are saying, hey, if Amazon buys this, then it's going to be hard for me to sell my robots on Amazon because Amazon's going to give itself preferential treatment. And also they were asked about, is there a privacy issue if Amazon is collecting all that data? Because supposedly the Roomba robot could collect data on your house about square footage and the floor plan of your house, because the Roomba figures it out while it's running around, and all that data can get turned into maps. And so somebody was out there saying, is that a privacy concern? Just to let you know, whenever something big like Amazon comes along to buy something, there's a lot of questions that get asked. Some of them are reasonable, some of them are off the wall, but nonetheless, these questions have to be answered. Otherwise, U.S. Federal Trade Commissions will say, nope, you don't have my approval to make that acquisition. Now, the UK Competition and Markets Authority, which is basically a Federal Trade Commission in the UK, June 2023, they cleared the deal. They said, as far as we're concerned, it's cool, and Amazon could own iRobot and Roomba, and doesn't really bother us. But the European Commission in November 2023, they said, we've got real concerns about Amazon restricting competition, and we want to talk about that. So this is a big deal. You got to get all three of these cleared, otherwise Amazon's not going to buy the company. So this is like getting, if you've ever bought a house or know somebody that's bought a house and you're going to do a home inspection, you have to get a good home inspection report, otherwise you might not buy the house. Or you have to change the price if you find out that the pool is compromised and you have to spend 80 grand to put a new pool in. That's exactly what the inspection does. Well, think of this as the home inspectors on steroids when you're trying to buy a company. So over the course of the last several months, and here we go, here's the UK approval. Hey, UK, the equivalent of their FTC, what did they say? Hey, we're good. Stock goes up, it's up here. Then they have to go out July of this year, 2023. Hey, we're going to go out and get some debt financing. Whammo. And Amazon cuts the deal to $51.75. So you can see they were still paying more than the $41 that's on the market. See that? That's called the deal spread. But then EC warning came out, says, hey, we may not like this. We may have some concerns about this. What are those concerns? Well, while they're researching them, they're losing $13 a share on a trailing 12-month basis. And so the stock is trailing back down. But what happens here? One day it goes up like a missile, but then it comes right back down to here to 35 bucks where it is now. Well, something very interesting happened. So they're all waiting to hear about the European Commission, right? Because the UK says it's okay, and the US Federal Trade Commission says, I think we're all right with this. Well, but they're waiting on the UK, the Euro Commission, which is France, Italy, Spain, Portugal, all of the EU. Here's why the stock went up. Look what Reuters does. November 23rd, exclusive report. Amazon to win unconditional EU nod for iRobot deal, sources say. That's why the stock jumped up. Everybody said, hey, they got clearance to do the deal, man. It's going to happen. November 27th. Wait, 4 days later, you saw the spike went right back down? Hang on. EU antitrust regulators said Amazon's iRobot deal may restrict competition. We don't like it. Well, that means that whoever leaked this was wrong, or Reuters reporter got it wrong and an editor approved it. But 4 days apart, look at this. Yeah, that's what made the stock go up and down. Reuters is reputable, fairly reputable as far as I can tell, news source. And so the stock moved on the news. So what's next? EU, European Commission. European Commission is concerned about Amazon not being fair on the online store with robot vacuums that are made France, Germany, Italy, and Spain. Well, guess what? That's a big chunk of the EU. Germany is actually the largest economy in the EU. So when you've got this list on there, that means the EU is saying, wait a minute, some of our biggest countries are saying maybe there's a problem here. And Amazon has since asked for a closed-door hearing. They want to argue that Roomba is facing a ton of competition from all this stuff, and that we're not going to help or hinder it. We're going to be selling our own product, and we may give it shelf space and promotions and things like that. But this is a very competitive market. You shouldn't only judge it by our website. We're going to offer all these robots. And Amazon also wants to know about the irresponsible news leaks. They're like, and by the way, you better check yourself, EU Commission, because somewhere this news was getting out and a bunch of sources were telling, Reuters that this is what's going on. And so there's a problem here. And then iRobot, in the meantime, financial woes are growing in the face of sliding results. This deal may not happen. If you are Amazon and you're looking at them coming in this year, maybe only at $1 billion in revenue, losing $13 to $14 to $15 a share, Amazon may back out of the deal regardless of the issues with EU. Or EU may just never approve the deal, so it can't happen. Right now, when you look at the stock, the technical analysis of the stock, the market only believes there's about a 50% chance that this is going to happen. So that's why it was in the headlines. That's why it was such a buzz a week ago when we saw the stock jump up and jump down. Now you know what happened. Now you saw Reuters actually caused it. So what are the lessons for you and me? So this is a multi-billion-dollar company. It's going to be a 1.7, revised down to a $1.4 billion acquisitions. What lessons can we possibly learn? Aha, good question. I'm going to tell you. The lessons we can learn is when selling your company, what do the buyers seek? I can tell you, they want to see a growing company because what they buy today, they have to pay for the purchase price tomorrow. And so the company, if it's growing and growing in profits, that's what helps them pay for what they just bought. The second thing they're looking for is it an accepted, proven product or service? Accepted, customers are using it. Proven, they're using it over time, and we've had Rev 1, Rev 2, Rev 3. Well, iRobot certainly passes that test. It's an accepted, proven product. Growing company, a little bit of challenge there on the revenue side. Are there scaling financial results? In other words, are the financial results getting better? And what scaling refers to is basically, it's this. It's not having to pay for something twice. For instance, you have a building and you've got employees, and you add more employees when you increase your sales, but you don't double the amount of your employees necessarily. And so as sales goes up, all of your costs stay stable or grow gently with the sales, so that what happens is you end up with more profit. Because you don't have to pay for all of your senior executives twice, you pay for them once. You don't have to pay for your real estate twice, you pay for it once. And then as the sales go up and the gross margin hopefully stays constant or maybe gets better with economies of scale, then your operating expenses stay moderated, growing gently along with the increase in revenue, and you have more profit at the bottom. Ta-da! You have scaling financial results. and you compare them that they're doing at or better than your sector. In other words, other companies are in the same business as you. Are you more profitable per employee? Are you growing better per employee? All that goes in there. Then future growth potential with market and products. Is the market growing for your product? In other words, are more people going to be, using the tool that you make for home repair? And you only have 1% of the market right now, and you could keep growing to 2 and 3 and 4% market share. Well, that means you have future growth potential on the market. Products. Could you make other products that are very similar and add to make a product line or a product family? Future growth of the product. And finally, a skilled bankable team. You're skilled and you are seen as people that are going to be able to drive this further so that when they buy this growing company that grows in the future to pay it off. So it's a growing company, accepted, proven products and services, scaling the financial results, and being better when measured against companies that are in the same business you are, or at least equal to them, with future growth of the market and the products and the product line that is run by a skilled team. That's what a buyer wants to see. And if you're lucky enough to be part of large companies when they're bought, you're going to be unlucky enough to meet regulators like the Federal Trade Commissions who want to know about market consolidation when you're selling your company. But I hope this is helpful to you to take a look at that list when you sell your company. Because if you prepare years in advance for all of these things to be ready, then guess what? When it's time to sell the company, someone knocks on the door, you can say, look, I've got a growing company. I've been growing for years. I have a great product and service. We're already up at version 3. Our financial results are best in our market, and we believe there's more market out there, and we only have 5% market share now. We believe we could get to 10. And by the way, we got a great team here beyond me. Now you've got a buyer that says, okay, let's take a look at this, and maybe we'll pick it up. And again, it could be a strategic buyer, one of your competitors, or a larger company that's in the business, or it could be a financial buyer, a private equity firm that loves what they see here, wants to keep you guys around and keep the gravy train running and pay for what they've bought pretty quick so it pays off what they paid you. That's how it works. So I'm hoping the iRobot story can show you what happens when the regulators get involved, but also they're no longer growing, and that data and that basic product better still be really valuable to Amazon to want to pay for it, because the company really appears to be having challenges. But maybe Amazon wants all that consumer data, they value that, and they want the product that they'll put with Alexa, and that's what they want. They're willing to pay the price to it and effectively close the company and bring those products over to be part of the Amazon family. Maybe that's what they're thinking. That seems to be what they're saying in public. We will see. One thing we do know, iRobot is having some challenges right now, and even if it's approved by the regulators, maybe Amazon doesn't go all the way with this. And that, my friends, is the case study on iRobot this week.